Hi everyone, it's Kylie. Welcome back to my channel, Investing Basics, where I talk about the topics that I have deemed crucial to understand in order to develop a strong basic sense of financial literacy. This is the third video of the series, and today we will be talking about stocks, bonds, and mutual funds, which I believe are the basic definitions to understand in order to get into investing, and I think these are all very strong options for early and beginning investors to understand and get involved in. So today we are going to talk about both the positives and the negatives of these different types of investments. So let's get into it. First, stocks. Stocks are a partial ownership of a company. I like to think about it as investing into a stock and getting a small pie slice of a company. So you can think about it in both positives and negatives. That small pie slice will increase in value and be worth more money if the value of the company as a whole increases, which would mean that the stock price increases as well. So, say you had a little pie slice of a cherry pie, and then all of a sudden, that cherry pie gets more and more expensive, and people are coming to you saying that they'd buy your cherry pie slice off of you for a greater price than what you bought it at. That is how you make money off of a stock. You can sell your little sliver of a company after the value of the company goes up, and then that little part of the company that you owned will be worth more because the company as a whole is worth more. The same thing can be applied, however, if the company goes down in value. And if the stock price of a company goes down, you can also potentially lose money from stocks. Now, moving on to bonds. Bonds are basically loans, except the investor is doing the loaning. In a future video, I will talk about different types of debt and how compound interest, which I discussed in my first video, can work against you. But in this case, compound interest works for you because the loan that you give out is paid back to you with interest. So I talked a little bit about interest, but again, I'm going to get into it more in my debts video, so you can go and check that out. Basically, you are the one doing the loaning, and whatever money you put into it, you are getting paid back by the company in different time periods with interest. So that's how you make your money. However, if a company goes bankrupt or is going out of business, you might lose some money. That being said, bonds are prioritized over stocks to get paid back, in a sense, if that makes sense. So if a company is going out of business, they prioritize paying off the bond owners because they are indebted to them. Whereas stock owners are actually just partial owners of the company. So the company doesn't really owe them anything. So bonds are a little safer in that sense, in that you'll at least get some of your money back if a company ends up going belly up. And now, mutual funds. Mutual funds are a collection of different stocks, bonds, and other various securities put together by a professional fund manager. Now, this is a very interesting thing because it's an entire collection of a bunch of different types of investments that are already pre-made for you. And there are tons of different types of mutual funds. If you're looking to be in a more aggressive mutual fund that has a little bit maybe riskier investments, but are probably going to have a greater return and are looking to make more money quicker, you can invest in that. However, a lot of people, when they get older, tend to invest in some more conservative mutual funds because they are safer in the sense that they're less likely to decrease in value. And what's great about mutual funds is that they're a collection of hundreds, most of the time, of different stocks and bonds, and again, other securities. It can be only US stocks and bonds, it can be from international companies. There are all different types of investments that can go into a mutual funds, so it's guaranteed diversification, which I will cover in another one of my videos on this channel, so make sure to go check that out. I'll get more details into specifics of why diversification is really important for investing, but for now, you can think about it in the sense that if one of the stocks or bonds fails in a mutual fund, it's okay because there are tons of other stocks and bonds that you invested in just by investing into that mutual fund that will continue to be stable or go up. So that covers the basics. Why is it important to understand different investment types? Diversification. Diversification is incredibly important to understand for investing because it guarantees that you're not putting all your eggs into one basket, but that will be the next video that I cover. So thank you so much for watching. Please check out the other videos on my channel, and as always, feel free to ask me any questions in the comments section or by emailing me at womanandinvesting1@gmail.com. See you later.